mobile home parks, that kind of stuff, where they will buy them, immediately costing them out. Well, that takes away 50 to 60% of their depreciable basis right there. And then in a year or two, they'll sell it and they'll 1031 exchange. And they will not have to recapture that depreciation. But what they'll do is they'll go and they'll buy, for argument's sake, 2 new mobile home parks. Now, when they buy that, because they bought up, like Jay was talking about earlier, they bought more than they sell. That additional amount that they sell is new depreciable basis.
Welcome back to the Real Estate Reserve Podcast. I'm Jason Balin from Hard Money Bankers, co-host Ian Horowitz from Equity Warehouse. If this is your first time tuning in, welcome. I promise you will enjoy the next 30 minutes with us. If you're a return viewer, follower, listener, watcher, viewer, thanks again for all your support. As you know, we bring in actual, real estate investors and folks in the space that can help us all grow. This is a game of knowledge. The more you know, the more successful you will be. Today, we're going to bring in David Foster, who's a qualified intermediary for 1031 exchanges and the founder of 1031 Investor. Definitely looking forward to this conversation we're going to have with him, Ian. And Dave's also going to talk about a new book that he wrote called Lifetime Tax-Free Wealth, the Real Estate Investor's Guide to the 1031 Exchange. Definitely a popular topic, I think, among us recently, huh, Ian?
Yeah, it's always funny how our guests line up. We've been talking a lot about whole life insurance policies. We've been talking about trusts. The end of the year's here. There's some sunset provisions on inheritances and everything else that's about to happen. And I feel like this topic fits really well into where we are headspace-wise. So it should be a really fun show. Guys, if you get any value out of this, please share the show. We don't care about the likes or the subscribes. We care about, supporting our guests who come out, who are real people doing real deals. These aren't gurus. These are people that we use on a daily basis. People that are friends of ours, they're doing the same things we are. So the best compliment we can give is a share. More than a subscriber light. So I'm excited for this episode. But before we do that, Jay, I just want to let you know we officially got our first sponsor of the show, Buffed Energy by Brotherhood Buffs. You guys can get your cans at officialbuffedenergy.com. Enough about us, and let's bring in Dave Foster. What's up, brother?
That's the best introduction I've ever had. I just wish I had a buffed right with me.
Well, we'll have to mail you down a case. They just came in today.
Nice. Hey, Dave, how are you? Welcome to the show. Why don't we start off? Just tell us a real quick backstory, a little bit about you.
Yeah. So, in my day job, I am a degreed accountant who functions as a qualified intermediary for 1031 exchange. That's really where I'm at business-wise. We perform 1031s for others, and we're going to get into that, talk a little bit about that. I think in my other life, I'm just like you guys. I'm a frustrated real estate investor who never met a deal he didn't think he could do. The question is, how do you limit yourself? For me, it's very easy. My wife does that. She just says, no, not that one.
I got a wife too, but it just happens to be my business partner. He keeps me in line, and then my wife, I get home, and then she just yells at me and says, "Why didn't you do more?" So it's I'm stuck in the middle. I got 2 wives. So.
Well, yeah, but Ian, my favorite was my wife actually did this to me once. I showed her this house that actually turned into a major motion picture studio set.
Okay.
She looked at the house and just went, "You're on your own." So much for the wife as business partner, right?
Yeah. Well, maybe she saved you a fight that night. That's all. So it's all good. Somebody was looking out for you, Dave. So you got into the 1031 game. You made a comment or a joke that I can appreciate. Frustrated real estate investor. I'm guessing from your accounting background, like why 1031s? Like why are you passionate about that, and what keeps you attracted to it?
1031s are what have made all the difference in my life. And this goes back 30 years when my wife and I decided as we had our first child that we did not want to take a normal path, that we wanted to get this, the Minneapolis girl, the Kansas farm boy living in Colorado, wanted to buy a sailboat and sail away, raising our kids on a boat. And we figured that the best way to do that was going to be through real estate investing. So there's the genesis, right? Well, my very first deal, I did great. Bought a property, fixed it up, put a renter in it, sold it to another investor later, made a ton of money until my accountant reminded me that I had a silent partner whose name was Uncle Sam. And Uncle Sam actually did better than I did on that house. Well, that put the 10-year sail away goal in jeopardy. So I started figuring out, how can I avoid this next time around? And that was right when the IRS lost a major court case. And now 1031 exchanges were going to be available to just ordinary investors like you and I. And as soon as I saw that, like you said, Ian, with my accounting background, I went, this is the answer. And so we started forward on that. And sure enough, 10 years to the day, we had positioned our real estate from Colorado to Connecticut to Florida, never paid a penny in capital gains tax, generated enough tax-free dollars to buy a 53-foot sailboat, and we sailed away raising our 4 kids on it while living off of the income from our vacation rentals, never paying another penny of capital gains tax to the IRS.
Yeah, that's that's the secret, right? It doesn't matter if you voted for Uncle Donnie or Uncle Joe, it doesn't matter, right? Like there's always going to be the government out there with their hand out, right? And I think you make a very important point of like not paying the taxes. I know Jason's business, he's a little more tax intensive. He makes me sick every time he tells me how much he pays in taxes. Yeah. And 1031 is a good way to avoid it. So like, I know we've done some 101 episodes before, and we're going to take this high level, but before we go any further, 1031s are only available for investment properties and not needed on your personal properties before we get to that next level. Because some people are house hacking, and we just want to kind of clarify the two.
Well, but I tell you what, there's a huge application for all the house hackers out there, because this can actually be very, very awesome. You're absolutely right. 1031 exchanges are the sale of a piece of investment real estate, followed by the purchase of investment real estate. And if you buy at least as much as you sell, if you pay attention to the time frames, you will indefinitely defer paying any tax on gain and any depreciation recapture. But you're right, it's tax deferred and it's investment property. Now, the house hacker or just the person that lives in their house has different rules. If they've lived in their house for 2 out of the previous 5 years, then they get to sell that. And if they're single, take the first $250,000 of profit tax-free. That's doubled if you're married. But here's where it gets really cool. Let's say you're in California and you've got $1 million in gain on your house. Well, if you sell it, you're only going to defer the tax on $500,000. And if you're in California, you're looking at paying another $150,000 of tax. So what you can do is move out of that property, turn it into an investment property for a year. After a year, you then sell it. Have you still lived in it for 2 out of the previous 5? Yep. So you get $500,000 tax-free. But you can also do a 1031 exchange on the remainder and go buy new investment property. That's one application. Another one would be someone that owns the duplex and their house hacking one side of the duplex. Well, when you sell that, you're actually selling 2 different pieces of property. The primary residence side gets tax-free treatment. The investment side, you get to do a 1031 exchange on. So again, no tax.
Yeah.
What if you're just renting out bedrooms? Or you're renting out the basement or the space above the garage? Same exact thing. Or the two-story brownstone in New York, where you rent out the second story. That's one sale, but you can carve it into two sections. One for your primary residence, tax-free. The other for a 1031 exchange, tax deferred. So that's one of those little life hacks that for the house hackers can be a huge thing for them.
So on following that scenario, and they don't necessarily just need to, let's say they want to up asset classes, and typically that is part of it, right? Like you can't necessarily, like, it's got to be a higher price point property than before, right? So if you sell it
You
at
want to defer
100,000,
all tax, yeah.
yeah. So let's say somebody wants to, change asset classes, right? So they do that exact same scenario. They had a piece of residential property, and then they decide they want to invest in a commercial piece of property. I'm assuming same situation. They can invest that way, either a property that they're the general partner and they're operating themselves, or maybe even as a limited partner, that someone else is operating.
Yeah, now we're starting to move into an area where it is important that the taxpayer for the old property be the same as the taxpayer for the new property. So if I sell a piece of investment property, it doesn't matter what it is, I can 1031 exchange into any other type of investment real estate. That doesn't matter. But what does matter is that the tax return that reports the activity of my old property has to be the same as the taxpayer who reports the activity of my new property. So if I owned it just as myself personally, I need to own the new property as myself personally. This is where people struggle a lot with syndications, because as a limited partner, you're not investing in real estate. I know it feels like it, but you're not. You're actually buying a membership interest in an entity that owns real estate.
Oh.
So you can't 1031 exchange into that. Does that make sense?
It does.
Yep.
But because I'm Dave and
I'm waiting for the butt.
There's a few things that you can do. So number one, I am never a fan of it's such a trite phrase, I hate to say it, but letting the tax tail wag the dog. In other words, don't do something just because you're going to save taxes. Do something because it benefits you the most overall. Maybe that syndication is so juicy and lucrative, and your experience is such that you want to get out of active real estate management, then it's worth selling, paying the tax, and then taking the post-tax dollars and investing. Nothing wrong with that at all. But I tend to look for ways that we can avoid that as well. And one way that you can do that is if the syndication will actually allow you to purchase a tenant in common interest in the real estate that they own. Now, it takes a little bit of effort on their part. And what we're typically seeing today is that unless you're maybe a $500,000 or $1 million investor, a syndicator is going to have a hard time opening that up for you. But if they do, great. That's awesome. What a nice way to do it. Here's another way to do it. What if you did a 1031 exchange and sold $500,000 piece of property that had, say, $300,000 in loan on it, or $200,000 in loan on it? When you sell that, you just generated $300,000 in cash. And to follow the rules of 1031, which, like you said, Jay, you got to purchase at least as much as you sell. So you'd have to buy $500,000, right? Using all $300,000 of proceeds to defer all the tax. Well, let's buy a property for $250,000 cash, no debt. I can use the proceeds any way I want. And then let's take the remaining $50,000 and let's go buy another $250,000 property using debt. So did I defer all tax? Absolutely. But look what I now have. Off on the side here, I've got a $250,000 piece of property that I could immediately refinance and pull out, say, $200,000
Yeah.
tax free. And what am I going to do with that $200,000? I'm going to go invest it with my favorite syndicator. And I just made that happen without paying any tax.
And then you don't have to do the tick deal because you bought it in cash. Right. Let's say this was all going down at the same time. You buy the house, you refi it, then you can put it in the syndication, not have to do a tenants in common deal.
Exactly.
One step of clarification there that I'm interested in understanding is when we syndicate a deal and Jason says, hey, I got some money I want to put in, but I'm 1031ing it into your syndication. When he does that tick piece, is there more accounting on my end? Like, what's the difficulties from the syndicator standpoint and the person that's putting the money in? Because isn't there some additional reporting required?
Yeah, well, what ends up happening is that basically you've now got a partner in your syndication. You've got the general partnership probably set up as an LLC.
Right.
And now you've got another partner that also owns part of that real estate. So the tricky part is how you structure the relationship between the two. It's not impossible, but it is going to take some further definition and some creation probably of some different ways to manage the cash flow so that they're getting the same benefits as a limited partner, even though they actually own part of the real estate itself. And then you'd have to make sure that you yourself, as the general partner, are still in the driver's seat, obviously, on all decisions.
Yeah. No, that makes sense.
So going back to that scenario you used, so the first one, the 300,000 was, bought a property in cash, 300 grand. I got that free and clear. The other one, you said you were using the other set of the money to buy that second property and then just getting debt on that, right? Because there was 50,000 left over.
Yep.
So does the debt have to match up with the previous property?
No, that's the beautiful thing, is that you can allocate your proceeds any way you want. People like to think about this debt component. The IRS really doesn't. The IRS says that you need to purchase at least as much as your net sale, and you need to use all of your proceeds. As long as you do that, you'll defer all tax. Nowhere do they say that you have to recreate the same debt component. You could bring your own cash and make it an all cash deal. You could use 250,000 on one property and 50 on the other. Doesn't matter a bit. And that's where the opportunity lies. Because just in general, if someone is doing a 1031 exchange, how do I ever get the juice out? Well, the answer is you structure your 1031 exchanges so that you are slowly clustering and concentrating your equity into few properties, so that then at any point in time you want, you access a refinance, and that refinance is tax free. And then you can pull that money out and do anything you want, but you haven't harmed at all the integrity of your tax deferred dollars. So that just continues as long as you want.
Yeah. I was going to change this up a little bit to some other things, but another thing related to this, because I think a lot of viewers would be interested in this. So let's say you took $100,000 and you invested as a limited partner in an office building, and then that office building sold and you were going to get your proceeds back. Can you 1031, even though, again, if it's not tenants in common, then you're an owner of that entity, not necessarily the property. Can you 1031 those proceeds into another limited partnership that's set up the same way?
There's a backdoor way to do that where the syndicator themselves can do a 1031 exchange on the whole project. And we're actually doing a couple right now where the syndication already lined up their target. They're under contract to buy. And we've structured the due diligence periods to accommodate both. So they are then selling the entire syndicated property and doing a 1031 exchange. Now, it's the general partnership that's selling it because that's the taxpayer, that's who owns it. That general partnership is going to own the new property as well. All of the limited partners are simply going along as members of the entity because the IRS doesn't care who the members of the entity are. They only care that it's that entity that's doing the 1031. So that's the way to do it if you're an LP. If you're in a tenants in common situation, then yes, when that sells, Ian is selling his general partnership portion. You are selling your portion. And you can do a 1031 exchange on that as well.
Interesting.
Yeah, that and that's where there's some, I don't want to say, it's not like trickery, but I think people start to get lost and they're like, oh, well, either I'm in or out. But I know there's ways to do that. A common statement that we have heard is 1031 till you die. We've heard that through a few other tax accountants and 1031 people, and you're making a great case for it, right? Like nobody ever wants to pay the government, but Jason and I are sitting here. We spent a lot of time talking about whole life policies, infinite banking, inheritance, trusts, all that other fun stuff. How does 1031ing and say trust come into play? Because 2026, there's inheritance law, and I don't even know if they even cross paths, because I think there's kind of two different strategies here. But will 1031 help with like any legacy pass on to your kids? Like the pitfalls, or like how does that work into someone that's trying to estate plan and say, hey, family, I'm giving you these houses. What do you do next?
Dude, the last thing you want to do is tell them that early.
Right.
One of mine decided to go to med school after that. I think he's going to figure out how to pull the plug. No, you're absolutely right. Swap till you drop, right? So the idea is there are 4 Ds of 1031 investing that will benefit you through your life. The first one is to simply start and defer, because as long as you are deferring that tax is generating a return for you, whether it's 2 years or 30 years. The second D is to defer, because you can use the 1031 to respond wherever the real estate market is. Jay said it best when he talked about changing asset classes. Every real estate market is different, and every time in a real estate market is different. And early on, it might be good to invest in single family, but then it morphs into the opportunities in commercial, industrial, self-storage, whatever. But you can use the 1031 again to keep the deferred tax working while you move your real estate into any sector and any location. So the third D is that just like the 1031 can react to wherever the market is, the 1031 can react to wherever you are personally in your life cycle. Are you into acclimation mode? Well, you can use the 1031 exchange, what we call diversification. Sell one property, buy 2. Sell small, buy larger. You can use it to change asset classes if you're wanting to maybe move and become more passive. So sell single family rentals or vacation rentals. Go buy large managed self-storage facilities. Those kinds of things. Are you at a point in your family life where it's time to start creating memories? Go buy vacation rentals. Use the 1031. Buy the vacation rental. Now you get to use it some for personal use. You're also generating income from it. All of those things shape wherever you're at in your personal journey, which leaves us then with the last D, which is to die. Because when you die, trust, single tenants, joint tenants, whatever, when you die, your real estate gets what is called a step up in basis.
Yep.
That step up in basis means that your heirs inherit it as if they paid market value for it on the day you die. So you don't pay the tax all your life. They don't pay the tax. Your estate doesn't pay the tax. Where's the tax go? It just disappears. And that's the greatest legacy you can give to your heirs.
Yeah.
Start going forward.
Yeah, no, that's what we thought the setup was their basis, readjust to today's value, which is the magic of all of it. And then your next generation could screw the whole damn thing up, even at today's market value. And no, I'm just kidding.
They say it skips generations. We're actually I have one family that we're actually on their third generation, which I know makes me as old as my hair. But what happened was we started doing 1031 exchanges for Grandpa not too awful long before he died. When he died, his son inherited it all. Now, we did not hear from son for a while. Why? Because he got the step up. So he was buying and selling without much profit in him for a while. But sooner or later, that caught up. And then he started doing 1031 exchanges with us again. He died a few years ago, and his children, the grandchildren of Grandpa, are just now starting to do their own 1031 exchanges on this real estate. They've shaped their own portfolios. They've built their own magic that they like. But one thing that 3 generations have not done is pay a penny in tax.
Well, yeah, but isn't it still part of the estate though? So if, let's say it's over $13 million and you're an individual, or 26 million as a couple, wouldn't you'd get taxed on that, right?
Yeah, there's going to come a point where it's going to break through those sorts of thresholds.
Yeah.
The answer to that is just have a lot of kids.
Yeah.
How will you spread out the inheritance?
So is that and I know this is, we're reaching into some other topics, but so is that 26 million as a couple? That's per kid? So
I'm not even going to try to speak to that.
Yeah, okay. I'm just curious
because I haven't researched it. That
I know
I'm a few years from it. So, and how it goes. The estate limits change every year.
Yeah,
and then they sunset. They change every year. So we just got one bunch of people out, or we're in the process of it. Who knows what the next ones are going to do?
Well, what's funny is he set that up thinking he'd be there for 8 years, and now he gets to readjust it again. So it'll be interesting because it sunsets in 26. It'll be interesting to see what happens, and we'll keep doing some shows around that. But you brought up an interesting point. Now let's just say Grandpa is on deathbed and he's like, "I don't care. I want to give you the money. I want to sell it." And let's just say he bought the house for $100,000 29 years ago. He's burned through all of his depreciation, but that same house is still, for some odd reason, still worth $100,000 at market. My understanding is that he'd still be liable for, he used $100,000 of depreciation. He sells that. He's still going to be taxed on $100,000, right? Because he's more or less returned his basis. So then there's a case to 1031 in that situation where, you've paid your house off, you've owned it for a long period of time, you're at a depreciation schedule. There's just because you're selling something not for more money, you could still technically be making money in the eyes of the government. Is that true?
Oh my gosh, yes. Yeah. Let me tell you about a bunch of poor people in 2008 who were clients of ours who would literally go to the closing table and have to bring cash and still have a tax event, because they were selling it for so much less than they had refinanced it for. But because of depreciation, they still owe tax dollars. But here's a good one for you. It's actually very conceivable today to buy a property, only own it for a year, and sell it for exactly what you pay for it, and still owe a huge tax bill.
Go on, talk to us.
Because somebody put a little whisper in your ear and said,
accelerate depreciation.
Yeah. Let's get some cost sake depreciation benefit right now. And which is awesome because you get that. But depreciation is such a lousy gift from the IRS, because what they don't tell you is that when you sell the property, you have to pay it back.
Yep.
It's only a gift while you own the property, unless you 1031 exchange. So there's a whole fleet of people out there with, particularly with industrial assets, large vacation rental type assets, those kinds of things. So I buy a mobile home park for $1 million, depreciate it to 500,000, and or let's just say depreciate it to zero. But then I go and I buy 2 mobile home parks, each for $1 million. I don't get any more depreciation on that first one, but I just bought myself another $1 million of depreciation on the second one. And that's what's so key for people who love to cost save and people who are trying to get rid of material participation tax losses or tax gains, is that you could use that depreciation against it.
Right. Yeah. So there's a case to store up some depreciation, knowing that, hey, you might sell an asset here, right? Like, because we have depreciation that's stacked up. So we just did a sale of a property, and there's a case to be had that we might not have taxes on those proceeds because we have other stored up depreciation that we can utilize against that. Because, well, there's a whole nother level of stuff, right? Because you can only advance so much forward, and what is it called, catch up, or you can only use 80% of your forward or backwards losses. I forget what they said.
Yeah, and it's limited to a certain amount of year, but think about the simplest way to apply that later in life when RMDs start to hit. Well, RMDs from your retirement accounts generally are not huge, but they cost you a little bit. And even though you're limited in the amount of depreciation you could take, wouldn't it be nice to have a whole bunch of depreciation just sitting there waiting to offset required minimum distributions?
Yeah.
Or why not leave it in there forever and never pay tax and die?
Smart.
Again, it's just a second best scenario because dying ain't fun, but we're all going there.
Yep. Yeah, you can't, taxes and death, right? So, 2 guaranteed things in life. What, man, there's something else I was just going to ask you. Go ahead, Jay. Literally just slipped my mind.
No, I'm good. I mean, this has been great. There's a lot of good stuff that I think is very valuable to a lot of people listening, because a lot of folks aren't, there's so many unique situations, and it's hard to determine, these are all kind of hypothetical things that we've been kind of talking through, and it'll resonate. Some things will resonate with one and it might not be the other. And it's funny because, you can talk about this, teach this, have a conversation with real estate colleagues about this, but until they're ready for that in real time, it kind of just goes in one ear out the next because it's like, well, this doesn't relate to me at this point. And then all of a sudden, like for instance, I'm talking to my CPA about a bunch of stuff that I'm doing with a whole life insurance policy. And in essence, if I can expense some interest from policy loans and stuff like that. And it's stuff that's just like so relevant at this time that, I've had conversations about it 10 years ago, but it wasn't relevant at the time. And now it is. And it's like, hey, let's just dig in. So no, this is good.
Where were you challenge you for a second?
Yep.
Because you just said something that's always raises the red flag to me. Taxes and death. My friend, I will admit that death is inevitable, but I will not say taxes are.
Yeah. Okay.
Here's a hack. You guys will like this one. It's, again, like you said, Jay, sometimes someone will want this. Did you know that you can convert, like we talked about at the very beginning, converting that property to investment so you can do a 1031 and get the primary residence? Did you know that you can also convert investment property into your primary residence so that you can take advantage of a prorated tax-free event when it's sold? Here's how one of my clients did it. He was getting ready to retire. He bought 3 in a 1031, bought 3 identical beachfront condos in St. Pete.
Okay.
Now, lots of taxes built up. He used them for investment for a couple of years. Then he moved into the first one, converted it. Now, as long as you own the property, you don't have to pay the tax. He lived in it for 3 years, and then he sold it. Now, when you sell it, there's a tax event, right? But because he was selling a property that he converted into his primary residence, he got to take a proration of the gain tax-free. He got to take 3/5 or 60% of the gain tax-free, and he paid tax on 40%.
Hmm.
Yeah, you actually can convert deferred tax to tax-free. If he had lived in it for 8 years, he would have gotten 80% of the gain tax-free and would only have had to recapture depreciation.
Interesting.
So where do you think he moved when he sold that first property?
To the other one.
Exactly.
To the other one.
Yeah.
He had 3 of them, so he's going to
That's
go to
his-
the next one and then the next
That's
one.
his whole freaking retirement plan.
He's doing the reverse house hacking.
Yeah, I like it.
Exactly.
And chances are they're probably higher end properties, at that point than, what most, house hackers do.
Right. Well, his whole job is sitting on the back porch watching the ocean come in. And
I like that job.
Yeah. Not a bad job. Not a bad job. Dave, just one more quick question for you. What is a major pitfall to 1031s that people might not be thinking of, right? Like, I agree with you. I'm pro 1031. I think it's one of the best things the tax code has given to us. But what's just a major pitfall someone should watch out for if they're going to enter into a 1031?
Like any other thing where it's got multiple steps and multiple strategies, you have to mesh up the strategy using 1031s that's going to work best for you, because there's a dozen different ways to use them. So I would say the number one pitfall is that people simply think the 1031 exchange is, I'm going to sell a piece of real estate, I'm going to go buy a piece of real estate, and I'm not going to pay tax. And so they don't plan ahead 2, 3, 4 steps down the road to create the off ramp later that fits with them. So I tell people the time to start planning your 1031 exchange is way before you're ready to sell a property. You want to learn about them. You want to learn the applications. That's a lot of why I wrote that book, was to show people strategically how to use them, and then back up to today, and then start to plan tomorrow's steps. It's all about planning.
Yeah, I agree. Makes sense. And does the process work similar if someone was trying to 1031 a business?
Well, that's an interesting question, because up until, I'll ask you, what president do you think was the one that tinkered with 1031 exchanges and eliminated some of it? Do you think in the last 20 years, which president would have done that?
I mean, I don't know. There's only 3 to choose, right?
Right.
4.
Well, we know that President Biden was no fan of 1031s. He wanted to get rid of it. We know that Obama was of the similar kind of conviction, but he didn't mess with it. The person that owns the most real estate, that loves real estate, dodges, it was himself. The Donald actually eliminated businesses and personal property from 1031 exchanges in 2018. But do you know why he did it? He did it because by eliminating that, he was able to bring in bonus depreciation and cost segregation in the Tax and Job Saving Act, which meant that 747 of his, he probably wrote it all off in 2018.
Makes sense.
But it took away personal property so that now you can only 1031 real estate.
Yeah, okay. Yeah, see, for some reason I thought like you could on businesses and stuff as well, but I guess not. Just real estate. Interesting. It's good to know. Good.
You messed up Jason's whole question.
I know.
He was.
I was seeing if I could 1031 a
was
hard
hopeful.
money lending. I was going to see if I could 1031 a hard money lending company, or if I could buy, a hard money lending company with 1031 proceeds of another one.
No, but what you could do is sell your company and then buy real estate and then just immediately cost seg the shit out of it and try to defer as much cash. So I have an investor buddy. He got bought out of a partnership and he couldn't 1031 or didn't want to take the steps to 1031. He got $1 million. So he went out and bought 3 self-storage properties and immediately he bought 1 self-storage property and 2 apartment buildings, immediately cost seg him to offset as much of his taxable gain to get out of that situation. So I thought that was a pretty interesting technique.
Yeah. So there's a couple of things here. The first one is you can't 1031 the real estate component of a business. So if you wanted to sell a piece of real estate or actually, let's say you wanted to sell your business and you happen to have your business in a building that has your name on it. Well, you sell the building and you allocate as much as you can of the value to that building and as little as you can to the value of the business. 1031 that. The second thing to look at what illustrates this is look at any major downtown. What do we see? High rises, and every high rise has a name on it, doesn't it? They don't do that because it's great advertising, although it is. They do that because that 70-story tower is a real estate asset that they can draw on anytime they want to pull cash out in refinancing, to take advantage of depreciation on it, to sell and 1031 into whatever they want to keep them whole. That's how the big players do it. But you don't necessarily think about that when you're looking at it downtown. You just go, oh, there's the Wells Fargo building. Yeah. There's the Jason Balin building. Yeah.
How'd you know? Come on up north. You might see it. Tell us about Lifetime Tax-Free Wealth, your book.
Yeah, I started out thinking that, like everybody, I got to write a how-to book because nobody knows how to. And because the government doesn't tell you how to. And it'll make my job easier because people will then know how to. By the time I got done with it, I realized that what it actually done was created a series of blueprints that people could use and adapt for their own strategy to take themselves where they are today to their death and beyond without paying tax. So it's very heavy with case studies, real studies from people that we've worked with that gave us permission to talk about them, as well as some how-to strategies and just different hacks that you can use along the way. And that's what we've done.
Yeah, I'm definitely going to grab a copy and check that out because it's just good to know. It's a tool in the tool chest, right? It's another arrow in the quiver or whatever the heck they say, right? Like you just need to know about it at that exact time that you want to use it. But if you don't know about it, you can't ever get yourself out of a situation and utilize it to your advantage, right? So,
well, I'd love for everybody to learn from my mistake of 30 years ago having a $30,000 tax bill, because there's probably not a month goes by that I don't sit and look at my finances and say, gosh, if I would have had that 30,000 working for me for the last 30 years, what would I have right now?
That's a very, very valid point. And compounding interest is the eighth interest of the world, or the eighth wonder of the world, right? So, David, what besides your book, what's we like to ask everybody, what's one good book or podcast that you enjoy that you think everybody should read or go check out?
There's a book that's so relevant right now, but it was written almost 20 years ago, and it's written at the 8th grade level, so I understand it. And it's called Whatever Happened to Penny Candy. It's by Richard Marbury, and it is the absolute best primer I have ever read on monetary policy as it relates to and as it impacts inflation. And if you are not a student of inflation right now, you're missing the boat, because there are both opportunities and threats out there that will grab you and ruin you if you're not ready to tame this inflation monster, whichever way it's going. You have to be poised. Richard Marbury, whatever happened to penny candy?
Yeah, we'll get that in the show notes. I'll have to put that on the download. It's funny you bring that up because I'm deep into the Jekyll Island book. Man, I forget the name of it, but it's all talking about the Fed, the IMF, monetary policy, why it was created, all these other ancillary groups. And I'm like, so we live in a farce. The whole thing's a farce. But I was actually joking with Jason the other day. I'm like, we're studying all this, but why? And it's funny that you bring that up. Is like, you need to know what they're doing to then be able to make better decisions for yourself. So that's really good.
The greatest piece of advice I was ever given by a mentor was, he said, stop thinking about the tax code as the way they get your money so they can build roads and hospitals. That's not it. Start thinking about the tax code as a behavior incentivizer. There are things they want you to do. And if you do them, the tax code rewards you. And when you start thinking about that, you start looking at, what do they want? Oh, where's that rewarded in the tax code? Oh, let's do that. 1920, they wanted a vigorous, prosperous, active agricultural real estate market because our nation was hungry. And so what they had, farmers could not sell farms and buy bigger farms because they didn't get the cash needed to pay the tax and buy their new farms, which also kept entry-level farmers out. So Section 1031 was put into place in 1920. What's the desired behavior? Sell your real estate. Go buy new real estate. How do they reward you? You don't have to pay the tax. There you go.
That makes a lot of sense. There's the backstory to 1031s, and I think you're 100% right there. Dave, if people want to follow you on the internet, they want to learn more about what you're doing, how you're enjoying your 1031, not paying the United States government, the legal way, and enjoying your life, where can they find you on the interwebs and learn more about you and your company?
Yeah, best way is just to go to the 1031investor.com. That's got links to our YouTube channel. I think we've got like 65 different short videos. There's a lot more to, when you're a nerd like me, you can find all kinds of little nuances to teach people. So links to the book, links to that, links to calculators. Come on by and say hi.
Will do. We'll get that in the show notes. I'm going to go check them out too, because I want more tools in the war chest. And this has been a really informative show, guys. If you got any value out of this, please go ahead and share it. I mean, it's the best compliment we can give Dave. I thoroughly enjoyed this. I know I'll be sharing it. Jason will be sharing it. And appreciate having you on, brother. And we'll catch you all on the next one.
Appreciate it.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.